Sometimes people ask me about 1031 exchanges and why I do those. So today I thought I'd explain a little bit about them. I want to start off, first of all, what a 1031 exchange is means that you can sell a piece of property as long as you don't touch the proceeds and reinvest it back into another piece of property. And that's what I'm going to go over today. And of course you don't have to pay tax on it. Actually, it's tax deferred, not tax free. Anyway, I'm going to read right now what the actual code says, because there's no way I can remember this. No gain or loss shall be recognized on the exchange of property held for productive use in the trade or business or for investment if such property is exchanged solely for the property of a like kind, which is to be held either and productive use in a trade or business or for investments. Now, you can definitely tell that these were written by attorneys. I could have said that in about one sentence a lot easier. But I'm going to explain how the 1031s work, and then you can make a decision whether you think it's best for you. Now, this is not tax-free. This is tax-deferred. So I guess theoretically, if you kept trading up until you die, it would be tax-free, but it wouldn't be tax-free for somebody else when they had to settle your estate. Anyway, I'm going to go over here and give you the rules on the 1031 exchanges. I'm going to start over here. First of all, you cannot have owner-occupied. These are for investment or business purposes. There is an IRS code 1034 that is for single-family dwellings that if you live in, you can trade those also, and they have their own rules and regulations. Second is, you can do personal property exchanges. I see it says person, but it's supposed to be personal there. And a good example of that was when I was a kid, Carol Rosenblum traded the Baltimore Colts for the Los Angeles Rams. And at that time, I didn't know what a 1031 exchange was, but I do remember the trade. So it doesn't always have to be real estate, which is what I use it in all the time, but you can use it for personal property also. Next is you need an accommodator. Now, do you always need an accommodator? No. If you actually sold one property and closed at the same time that you were buying another property and closed them both at the same time, you do not need an accommodator. But that's very rare, and it's so rare, I personally have never seen it. I have never done one that way. I usually do them delayed. They're called starker exchanges. So, but when they're delayed, you need an accommodator or a third party because you can't touch the money. So when you sell the property, the money goes to an accommodator's account. When you're buying another piece of property, that accommodator puts the money up for you and you've touched no money. So it's not a taxable transaction. Next is like kind. That is a broad phase. An example of that is you can sell raw land and buy a 20-unit apartment building. You can sell a 20-unit apartment building and buy an airport. It doesn't have to be exactly like for like. And what I mean by that is you don't have to sell a single-family residence and buy another single-family residence. You don't have to sell a 20-unit apartment building and buy another 20-unit apartment building. Instead, you can sell a single-family residence and buy a 20-unit apartment building, and that can be considered an exchange. Next, most parties, I just touched on this a little bit, are three-party exchanges and starker exchanges. I believe there was a lawsuit at one time, and that's why they call it the starker exchanges. But what that means is it doesn't exchange at the exact same moment that you buy and sell. All right, next here is it has 45 days to designate a replacement. The IRS allows you 45 days to designate, and you have to send the accommodator a list of 3 properties. Now, I have heard other people tell me that you can send as much more properties than 3, but I believe I read somewhere the IRS wants 3 of them designated. So I've always done 3 and then buy one of those. Now, you also have 180 days to close the transaction. That is 180 days from when you close the sale of your property, not from when you designate it or any other time. It's from when you sell your property. So if I close on January 1st, which is a bad day of closing, obviously, I would have till June 30th to close on the new property. Okay, now, if I pull any cash out, that is called boot. And boot is taxable. For instance, if you pull out $150,000 and you only put $130,000 into the accommodator's account, there's $20,000 left over. That is called boot, and that is taxable. You will be taxed on that $20,000. Now, I don't know how much, because I don't know if it's a short-term investment or a long-term investment or what. Okay. Mortgage relief. That's the next step. A lot of people forget this. What mortgage relief means is that, for instance, I'll use an example that I got here. I have an original mortgage on the property I sold. I still owe $1 million. Okay, I'm out buying a new property. Okay, the new property I've got a $900,000 mortgage for, whether I'm taking it over for $900,000 or whether I'm getting a new one for $900,000. Either way, there's a spread there of $100,000. That is called mortgage relief, and mortgage relief is taxable. So that's basically the 1031 rules to follow. If you follow those, you should be in pretty good shape. I've used these a lot, and I believe in them. So I suggest you all use them too. I would like for you all to go up to my YouTube and put in hashtag floydloans, and you can get all of my videos. You'll get this video, of which I'll have out. You'll also get other videos that I have out. You can also go to my Twitter, which is @floydloans, or my Facebook /floydloans. Hope to see you there.